There is one company that can stand strong against such threatening remarks. This is the WHA Corporation, the ultimate solution partner. Good morning, distinguished judges. The WHA has its 4 integrated hubs that work together as one. Its industrial development business that offers a one-stop service industrial land with utilities, power, and digital solutions provided to the customers for their production processes, coupled with the logistics business that specializes in world-class build-to-suit warehouses and factories, while also getting an additional source of income from monetizing and managing its REITs and a property fund. The WHA has been outperforming said index for the past 5 years. Today, we issued a strong buy recommendation with the 1-year target price of 4.84 baht per share, implying a 28.7% total stock return. So why buy, you might ask? We have our COMBO combo reasons to further your buying decisions.
Let's begin with C, crisis into industry growth. China has been promoting its economy and cooperation with Thailand to advance its One Belt, One Road initiative, as China is moving forward to green shift, phasing out polluting industries into digital economy. Plus, trade wars spurred investors to relocate their productions to Southeast Asia, and Thailand is their first choice. Also, the WHA offered a solution to diversify their portfolios into more stable, with well-adopted infrastructure and manpower. And why Thailand is the investment spot? First, it had a strategic location in the central sub-region. It can reduce time used exporting products to European countries. Second, it had the best infrastructure among countries surrounding China. Third, BOI has launched Thailand Plus package, offering appealing incentives. Lastly, it holds the 21st World Bank Ease of Doing Business, and the third in Southeast Asia. All this drives the growth of industrial estate industry. Moreover, 5G transformation increases the stability of automation, the demand for data storage, and the value of e-commerce market, in which every 1 million of the value creates the demand of 4,000 square meters for warehouses. As well as the demand of water supply in Vietnam drives the growth of utilities industry. So why does it have to be the WHA?
This is because of its #1 position in the industry. With the current leading market share of 43%, it is the largest among its main competitors in industrial estate business, namely Amata, Rojana, and Amanakon. And this is backed by strong competitive advantages, which are 1. The company has larger land stocks comparing to its main competitors, and all are concentrated at strategic locations. 2. It is the first in Thailand to use clustering concept, which can boost the customer efficiency and profitability. 3. It is the #1 in logistic property business, which is supported by large area under-managed and well-known tenants. And comparing to Fraser Property, the main competitor in this business, WHA is better and more specialized in build-to-suit properties. And all 3 reasons are possible. We confirm that with our team's company visit. And what's next for WHA? The company also has strong strategy to support future growth. Firstly, it is riding technology wave and based on the disruptive technology in all of its business hubs, and this is supported by the largest CapEx spendings among peers. In addition, the company highly emphasizes on strategic partnerships with global and regional players, as well as moving toward digital transformation with the world-leading technology companies, Bosch and Ground. And for the further growth strategy is through Vietnam expansion, where the company aims to capture strong FDI in Vietnam by investing in industrial estate project in Nghệ An, which is the largest province with the highest growth, as well as invest in Gold River project in Hanoi. And all that we have mentioned are the reasons why we can confirm that the WHA will continue to be the #1 in the industry with the expected share of 50%.
After we see the growth potential, let's take a look at how the company can make a profit from ROE decomposition, beginning with profitability. Firstly, the revenue projection, which has the main growth driver from a deal with Alibaba. And after that, it will grow by the monetization of assets, upcoming industrial estate project, Dong River project. And for the 3 businesses, their growth driver will be related to the upcoming industrial estate project. And out of this, will increase the proportions of recurring income. Secondly, the WHA also has a fully integrated service, along with a transformation plan to be the tech-based company. Overall, it will boost the margin up to be higher than the peer average at 36.6%. and that will also increase the net income growth at 7.6% CAGR. Moreover, due to the competitive advantages, it will make the ROIC to be higher than the WACC, indicating that the investments are profitable. Secondly, for the efficiency, WHA also has best efficiency among peers for using the asset to generate sales. Thirdly, the leverage. During the decreasing trends of interest rate, it will allow or be a room of comfort for company to roll over debt at a low rate, and that will increase the solvency of the company. For all the reasons, it will result in the highest ROE among peers, and then it will gradually move down to the peer average. So, after we know that WHA is a good company, is it a good investment?
Yes, indeed. Because WHA has many business hubs, we apply some of the parts DCF valuation and illustrate it in our pyramid. The bottom part is forecasted using top-down regression to arrive at industrial land sale and pre-leased area, before being adjusted with our estimated market share through the use of our industry survey. Then, the revenue and capacity of utilities and power will grow accordingly. The incremental rental properties of REITs and property fund are from the asset monetization of the WHA logistics, and at the same time generating recurring income to the WHA group in the form of dividend income and management fee. The bottom-up betas were calculated based on their corresponding peer groups and arrive at different level betas. And two of the discount rates are expected to gradually decrease toward the target DE ratio of 1. The perpetual growth rate of 2.18% is a revenue-weighted long-term GDP growth rate of Thailand and Vietnam GDP growth. And we arrive at the target price of 4.84 Thai baht per share, which represents a 25% upside to the current price. Our sensitivity analysis on terminal discount rate and terminal growth rate confirm our DCF buy recommendation. To support DCF, we apply relative sum of the past valuation and also the statistical approach to mitigate the fact that the company is lack of direct peers, and both methods have shown the higher multiple than current level, which imply an even higher price than DCF. Furthermore, the stock is currently traded at the PE level being lower than its 8-year historical level, which is a strong signal for a buy. To stress our analysis, we have done a 70,000 of Monte Carlo simulations and saw a 66% chance of a buy.
To complete our analysis, we have to take the risk factors into an account. Today, we focus on 3. Firstly, WHA depends greatly on its biggest portion of the customer, the auto and park industry. However, WHA mitigates this risk by making a long-term contract with the customer and making a shift of its concentration to the S-curve industries from the EEC project. From our analysis, it takes a decrease of 15% in Thailand annual land sale, and we still have a buy recommendation. Next, as the land price and development costs increase over the time, WHA mitigates this risk by passing the cost to the customer and making a continuous land bank purchase. From our analysis, it takes a decrease of gross margin of land sale to the level of 40%, and we still have a buy recommendation. As the company has many floating rate debentures, WHA mitigates this risk by entering into an interest rate swap contract. It takes an increase of 120 basis points in pre-tax cost of debt. And again, we still have a buy recommendation. With 5-star corporate governance scoring, along with the management, especially the CEO, Mr. Report, the business person of the year 2019. They can ensure you the leading position in the industry. To sum up our combo, crisis into industry growth, number 1 position, margin expansion, beat the market, and overrated risk. We are issuing a strong buy recommendation with the 1-year target price of 4.84 baht per share at 28.7% total stock return. Ladies and gentlemen, although the price had dropped, but remember, every cloud has a silver lining. Thank you, and the floor is now open for Q&A session.
So, thank you for the presentation. Can we go to slide 41? So, there was a major PE drop in There's a major PE drop in 2017. What happened?
Thank you for your question. The reason that the PE was significantly dropped in that year is because the company has launched the IPO of the WHA-UP and has used that proceeds from IPO to doing more JV with power plants. and the share of profit from the WHA-UP that year was significantly jumped. So that's why the EPS higher and PE was dropped, even though the price is also increased.
You mentioned to mitigate the risk of only a few big customers, they enter into the long-term contracts. Could you elaborate what kind of contracts?
Thank you for your question. Mainly in logistics business, the customer are mainly the auto and part industry and petrochemical industry. WHA has doing a long-term contract of over 10 years to have the rental income from the customer. So even though the industry will change over the time, this customer and industry customer will have to pay this rental income to WHA for the next 10 years.
Next thing, so the contract is 10 years, but at today, those contracts, how many years are left?
So they are on weighted average going each year at around 7 years left, and many years they always have the new customers coming inside, also including the deal with Alibaba that will have another next 10 years if they do not exercise the buy option.
I think you present us the capex for the future for Y, and you have also mentioned that they have issued a lot of debenture over the past. So how will they fund their capex over the forecast period, and what will the DE look like in the next 5 years?
Thank you for your question. The capital expenditure will mainly base finance on the rolling over of the debenture, which you can see on the graph below above that the new debt repayment will be higher than the new debt issue. So the IBDE ratio over the time will lower by on average at 0.1 time annually. However, on March 3rd, 2020, in the next month, the company will also have the warrant outstanding, which is real incremental share of 595 million shares outstanding. So the PE will drop a little bit over the time, but going over after 2020.
And can you explain on your assumption on the pre-sale assumption for this year?
Thank you for your question. The pre-sale assumption is that we run the regression for finding the pre-sale of total Thailand pre-sale and pre-lease area by making a main customer industrial growth and FDI as X variable to forecast Thailand pre-lease area in the next years. Then multiply by the expected market share to get the WHA pre-lease area over the years.
Thank you.
Okay. You identify 3 key risks, analyze, and then you say that you still recommend to buy. Can you share your view that what is the extent that you will move from the buy to hold from each 3 risks?
Thank you for your question. We actually run more than 3 risks in the sensitivity analysis, and it is shown above that, for example, Thailand annual land sale, it takes a decrease of every year annual land sale to decrease at 17% to change to hold recommendation, and the same apply to other variables.
Can you explain further on how you translate the FDI to industrial land sales?
How many years left are you expecting the transmission of FDI to land sales?
Thank you for your question. We use FDI to forecast and show that the regression R-square has the correlation of more than 80% in all of the other variables. And we think that in our land sale in both logistics and industrial development will show on average of the WHA land sale for the next 10 years at around 1,000 rides per year in Thailand.
So in your assumption, you expect whatever FDI you saw in 2019, that will be used to forecast the industrial land sales for 2020? Is that?
Thank you for your question. The FDI, we also separately run the regression. So we are applying double regression by finding the future FDI growth rate by running FDI as Y variable and X variables as inflation and GDP growth rate in the future.
To answer the timing, we use the same timing as the FDI and the forecasted land sale. For example, if we use the 2020 FDI, the output land sale will be the same year. which is 2020.
I think from your financial projection slides, the revenue is relatively stable, sometimes up, sometimes down. And then your forecast net profit will grow 7% CAGR because of the operating margin will improve. Can you elaborate what's the driver for the operating margin to improve?
Thank you for the question. Firstly, I want to mention about the gross profit margin that will improve because of our assumption that the company will have a better bargaining power. So we use the 0.6% as construction manufacturing index to forecast the real estate development cost that take the majority part of cost of goods sold. So the revenue growth will take very faster than the growth of cost of goods sold. And secondly, the WHA also has a technological transformation, so we think that the operating expense will reduce because of the shift from the traditional to the digital base. And that boosts the margin up by decreasing overall cost.
Where is this better bargaining power coming from? Is that gross margin going up because of better bargaining power?
Thank you for your question. We believe that the company can push and passing the cost to the customer, and by